When you think of banking, you think of a bank which takes deposits from customers and it loans those depositors out to borrowers. That is how we traditionally think of banking. And the traditional idea is that a bank will keep that loan to the borrower throughout the life of the loan. In other words, there will be a continuing relationship between the bank and the borrower. Thus, the bank will have a high level of concern about the borrower's ability to repay the loan over time. One aspect of the '82 debt crisis was the early development of loan sales and trading. In other words, bankers realized that they could actually buy and sell loans from one another. This was primarily a mechanism to work out the excesses of the 70s that had come to a head in the 1980s. But this idea that banks didn't have to hold loans to term, but instead could buy and sell them, was a very important, if you will, intellectual underpinning of the current crisis. The second was the international regulatory response to the '82 crisis, what is called Basel I, the 1988 Capital Accord. And essentially, the '88 Capital Accord is the dominant standard for banking regulation around the world. And at its heart is a simple equation. A bank must hold 8% capital to risk-weighted assets. Capital essentially is divided into two forms. Tier 1 capital, which has to be at least half or 4% of that 8, which is essentially shareholders' equity, whether common equity or preference shares. Tier 2 is a variety of subordinated debt instruments. The other side is a series of risk weightings for those assets. In other words, corporate loans are weighted at 100%. So if you make a $100 loan to a private sector corporate, you have to hold 8 units of capital, a minimum of 4 of equity and 4 of perhaps debt of some form. At the other extreme, government bonds from OECD countries draw a 0% risk weighting. That means that if you hold bonds from the US or German governments, for instance, you don't have to hold any capital against those assets. And importantly, the 20% category is for interbank lending. The assumption is that because banks are regulated institutions, it is less risky for banks to loan money to one another in the markets. And as a result of the importance of interbank lending, a lower risk weighting, which has essentially encouraged the development of large-scale interbank lending over time. The third aspect of the '82 crisis was a preference for bonds. Essentially, the main underlying instrument of the 70s leading to the '82 crisis was large syndicated loans. Following '82, bankers decided that the real problem was not that they had made loans to developing countries at interest rates which eventually those countries could not afford to pay back, but instead that they hadn't transferred the risk that the borrowers wouldn't repay to someone else. So instead of focusing on large-scale loans, bankers essentially began to focus on bond transactions. In other words, make the loan and then transfer the risk to someone else. The other points I want to highlight, over the 1990s, and especially following the U.S. savings and loan crisis in the late 80s, the development of a transaction structure called securitization, which had an important interaction with the new Basel capital standards. And essentially, in a securitization transaction, you have an originator of assets. Let's say a bank has made loans to customers to purchase residential real estate. Those loans are collateralized by the real estate. They are secured by the real estate. That is a residential mortgage loan. Essentially, the idea of the transaction structure is that the bank will sell those loans to a separate entity. That separate entity will issue securities, generally debt securities, into the markets. The money that it raises by selling securities into the markets will be transferred back to the bank to pay for the transfer of assets. A couple of important elements here. If you think of the Basel Capital Accord, one way to deal with capital requirements, and capital is a cost for financial institutions, especially equity capital, one way is to focus on lower risk-weighted assets. Another mechanism, however, is to get rid of the assets entirely. If you make a loan and you sell it to someone else, you don't have to hold capital for that loan. And if you have essentially been able to sell the loan, you can take the money from that loan and use it to make another loan, which you can then sell into the market, take the funds from that loan, which you can use to make another loan, etc., etc., etc. So essentially you can see this interaction between regulation and a transaction structure, which allowed banks to focus on a new business model